Hello, 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 hello. Good evening and welcome everyone. Is the audio and video clear? Please give me a check in the chat box if the audio and video is clear. Yes, thank you, thank you. We'll just wait 5 minutes for 9 p.m. and then we'll start the session. Yes, so hello and welcome everyone. So how many of you are trading in future and options? If you're trading in future and options, type FNO. If you're already trading in okay. Okay, 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 okay. Only equity, only equity. And how many of you? Okay, only equity. Okay. Bal Muruganji is trading in future and options. Good, good, good. So uh, today's today's class will be concentrating basically on the basics of options and how options work and how options behave and what are options. Tomorrow we'll be learning about option chain analysis and further concepts. One concept about option chain analysis, like put call ratio, max spin, and those kind of things. Today we'll be learning about options, type of options, what are the different components of an option, and also about option Greeks. Okay, so today will be a basic class, and I hope after this class you all will be knowing about options a lot more, and you will be understanding options from now on. Okay, so to begin with, why are people attracted to options? People are attracted to options because futures and options, these are like derivatives. They are derivatives. They are not like shares which we buy and sell in the stock market. They are contracts. Okay. So basic है कि भाई future and options जो है, these are contracts. They are not shares or stocks of the company. So they have a certain characteristic which is called as a leverage. What is that? Let us see why people are so interested in trading in future and options, and can we do trading in future and options which is beneficial to us. So suppose if I want to buy, I feel that Reliance shares are going to go up. There is some news that now Reliance has come into 5G. It is getting lots of contracts. The customer base is expanding. Idea and Vodafone are going to close down, or Idea and Vodafone are being taken over by Jio. Those kind of news which are in the favor of Reliance. And I feel that Reliance shares are going to go up. And I want to buy shares of Reliance. So with cash, I have the advantage that I can buy any number of shares which I want as per my capital. मेरे पास जितने पैसे हैं उस हिसाब से मैं रिलायंस के शेयर्स खरीदूंगा. बट अगर मुझे रिलायंस के 250 शेयर्स खरीदने हैं, ये 250 क्यों आया ये भी मैं आपको बताऊंगा. Why this 250 figure is coming, that also I'll tell you. But if I want to buy 250 shares of Reliance, then with cash, I have to have 5,98,225 rupees approximately, somewhere between 6 to 6.5 lakh rupees. Now I am buying Reliance because I think Reliance shares will go up. That is my view about Reliance. For buying 250 shares of Reliance in cash, I need 6 lakh rupees. Now 6 lakh capital is not something which everybody is done. But can we use some features of stock market to get advantage of this? Let us see. So if Reliance shares move by 100 rupees up. So for example, Reliance is presently trading at 2400 and Reliance moves up from 2400 to 2500. So I have invested 6 lakhs rupees for buying 250 shares of Reliance. And since it moved 100 points, then this 250 multiplied by 100 is my profit. I get a profit of 100 rupees on one share. I have 250 shares of Reliance. So I'll earn 25,000 rupees. Now, if you see this 25,000 rupees in comparison to the amount of money which I have invested in Reliance, then it constitutes to about 4%. 4% of returns on my capital deployed. I have deployed 6 lakh capital and I have got what 25,000. Now, what happens if I trade this same thing in future? If I buy Reliance future then I will be able to buy Reliance future at 1/4 the margin, approximately 1/4 the margin. So instead of 6 lakh rupees, I'll be spending close to about 1,32,000, 1.5 lakh rupees, 1,50,000 approximately. And my profit, if Reliance moves from 2,400 to 2,500, that is 100 points, then my profit will be same, 25,000 only. As much profit I will get as I can get by owning 250 shares of Reliance in my account. But the return on my capital, that is, I have deployed about 1,50,000 rupees and I got 25,000 rupees. So return on my capital is 19%, which is approximately 5 times the return on my cash. Now here is when things become more interesting. If I don't have 1,50,000 rupees, can I still use some feature? Yes, that is when options come into play. And I am expecting Reliance to move up 100 points. Reliance is presently trading at 2,400. I buy a call of 2,400 CE. If Reliance moves 100 points, then I will get 16,800. I will get less money as compared to future or cash. But the capital which I require to buy Reliance 2,400 CE is close to 16,000 only, which is just close to 2% of the amount required here. 6 लाख के बदले मैं सिर्फ 2% of 6 lakhs यूज करके I am getting 16,800. So my return on investment is 105%. This return on investment is what attracts everybody to the options. Everybody comes to the field of options and futures with the hope that they will get this kind of returns, 5x, 100% returns. But if you do it blindly without learning about basics of options, then you are going to not only lose your profits, but also lose your capital. So how should we think about it? So when we start option trading, 5 concepts which every trader should know before starting trading in options. First is futures and options. Derivatives जो है ये दो चीजें हैं. There are two different things. Okay, this is derivative. Futures को भी बोलते हैं और options को भी बोलते हैं. These are two different things and these are called as derivatives. Futures and options are derivatives. First thing, what do you mean by derivative? It means इनका अपना कोई value नहीं है. They don't have their own value. They don't have any value by themselves. Their price is entirely dependent on the underlying. Now, what do you mean by underlying? Now, suppose, let us consider the example of Amul butter. Amul butter is derived from milk. Milk से butter मिलता है. So, if the price of milk increases, all other factors remaining constant, the price of butter will also increase. If the price of milk decreases, the cost of producing butter will also decrease. You know? Take an example of gold ornaments or jewelry, gold jewelry. Gold jewelry are made from gold. So if the price of gold increases, then the price of jewelry also increases. If the price of gold decreases, the price of jewelry decreases. So cost of jewelry is not independent. It is dependent upon gold. Like the price of butter is not independent. It is dependent on the price of milk. So price of jewelry is derived from price of gold. Therefore, it is called as a derivative of gold. Similarly, coming back to our stock market, Reliance future is deriving its value. Reliance future का value is derived from Reliance future का value Reliance के shares पर depend करेगा. Reliance futures value depends on the price of the Reliance share. Therefore, Reliance future is a derivative of Reliance stock or Reliance share price. Similarly, Reliance options will also derive their value. इनकी प्राइस भी Reliance shares की प्राइस से अफेक्ट होगी. If Reliance is increasing, then the value of Reliance call will increase. Don't get confused. Call क्या है, put क्या है, वो भी देखेंगे. If Reliance share price is decreasing, then Reliance call value will also decrease. So the price of the options is derived from the share of the option, share price of Reliance. Therefore, options are also derived from underlying. What is the underlying in Reliance options and Reliance futures? What is the underlying in Reliance options and Reliance future? Come on. Keep it an interactive class. Yes, Reliance. Yes. What is the underlying in Bank Nifty? Type in the chat box, please. Bank Nifty. Very good. So concept first is cleared. Now the second concept, which is very important concept, is the concept of contract. We buy Reliance share, and as soon as we buy Reliance share, we become part owner of the company. We are part owner of the company. You buy Bajaj Finance, you will become part owner of Bajaj Finance. Okay. You buy any stock, you become part owner of that company. But that is not the case with derivatives. Derivatives are contracts. For example, in daily life, we see whenever we go for a deal in real estate or any other deal, and we are buying a house. For example, we decide to buy a house. The cost of the house is 1 crore. We don't pay 1 crore at the first step of the transaction. We pay a booking amount kind of thing, and we book it, and that price which we have paid, after paying it, we make a contract that I will be paying the remaining amount in so much time, and I have booked the price of this particular house at 1 crore rupees. I will be paying the remaining amount within next 6 months. So this contract which we make in real world, similar kind of contract is made in stock market. So the contract which we make in stock market are called as futures and options. Futures and options are contracts. What do we mean by contract? These have legal binding. We have to obey them. We have to fulfill them. So when I buy a future of Reliance, it means whatever happens in this future, I will be paying off if there is a loss. I will be getting money if there is profit. This is the concept of contract. So when I buy a future of Reliance, it means I am ready to buy 250 shares of Reliance before expiry. Now, if Reliance is trading at 2400 right now, and I buy a future of Reliance, and at the time of expiry, it is trading at 2500, I can sell this future at 2500 and earn 25,000 profit. This we saw previous slide. Now, what happens if this price goes down by 100 points and it closes to 2300? Then at that time, I will be booking my loss of 100 rupees per share. And I have 250 shares. So I will book my loss of minus 25,000. This contract, as it is applicable in future, it is also applicable in options. In options, let us first consider only call so as not to confuse you. What do you mean by a call option? Call option is bought by a person who feels that the underlying asset is going to move up. If he feels that the price is going to increase, he buys a call option. And if the price increases, he gets profit. If the price decreases, he books loss. These are plain, simple contracts like the real life contracts of real estate, which we sign at the time of purchasing a plot, a farm, a house, a flat, a shop. The kind of contract we do is similar to what we do when we are trading in future and options. Now, the next thing which we need to realize when we are comparing these real life situations is that the token which we pay while buying a house is similar to the premium which an option buyer pays. Okay, so when we are buying a house, there is a person who's selling the house. We pay token to the person who's selling the house for booking the price of the house at that particular price. Similarly, when we buy an option, we pay a premium to a person who is selling the option. So, option buyer pays premium to the option seller. Option buyer pays premium to the option seller. We will see more about it in detail. But just get this concept clear that option buyer, since he's buying an option, he pays a premium to the option seller. Now, the price which was agreed at the time of buying a house is similar to the option strike price. It is similar to the option strike price. And the price of the house at the end of the agreement is, means suppose I have decided that I'll pay the remaining amount in the next 6 months. So the duration at which I am ending my agreement in that real estate contract is similar to the duration of a contract in the future and options. So there are 3 expiries which are always available and can be seen in the market: the current expiry, the near expiry, and the far expiry. Current expiry means the expiry of this month. Near means the expiry in the next month. And far expiry means expiry after 2 months. So normally 3 expiries are what we generally see when we are looking at contracts of futures and options in the market. Now, second thing, options are always traded in lots. You cannot buy one option of Reliance, one share option of Reliance. Means I want to do a contract of 1 share of Reliance. That is not possible. You always have to buy futures and options in lots, and lot size varies from underlying to underlying. So a Reliance future will have lot size of 250, but a Bank Nifty future will have a lot size of only 25. A Nifty future will have a lot size of 50. On the broader terms, if we see, the futures are designed in such a way that the price of the futures is somewhere between 5.5 to 7.5 lakh rupees. This is the amount of capital which is included in the contract. So for example, when I buy 250 shares of Reliance by buying Reliance future, though I am paying only 1,50,000 rupees, but the size of the contract, is same as size of my cash transaction. So my contract is for close to 6 lakh rupees. I am able to do the transaction using only 1.5 lakh. But what am I dealing with? I am dealing with a contract. The value of the end result is 6 lakhs. This we sometimes tend to forget. And this is where we land in trouble, because we tend to think how much is the value. We are just putting in 1.5 lakh rupees, but we are putting 1.5 lakh as a contract value. The exact value of the end agreement is 250 shares of Reliance, and 250 shares of Reliance, if you calculate, it will be somewhere close to 6.5 lakh rupees. Now, this we have already covered, that the lot size is different for different underlying. So the higher the cost of the underlying, the smaller the lot size. The cheaper the price of the underlying, the more the lot size. For example, if you see, ACC Limited is having only 250 lot size, but Ashok Leyland is having 4,500 lot size. So this contract of ACC is a contract of 250 shares of ACC Limited. But this contract of Ashok Leyland is having 4,500 shares of Ashok Leyland. The value of the contract will be somewhere between 5.5 to 7.5 lakh rupees. Though we will be able to trade in any of these using a capital close to 1.5 lakh rupees. Get this very clear. Now, the third concept is the expiry. Now, indices. There are 3 indices which we see right now. Which one is Nifty, Bank Nifty, and Fin Nifty. Why only these 3? Because only these 3 are tradable. Now, you can buy Reliance share, but you cannot buy Nifty. You can buy Bajaj Finance, but you cannot buy Bank Nifty. If you want to buy something which is equivalent to Reliance future, then it is Nifty future, Bank Nifty future, Fin Nifty future. If you want to buy something like a Reliance call option, then there is Nifty call option, Bank Nifty call option. Okay. As I have told that 3 months contracts are available at any given time: current month, near month, and far month. So if you go and see Reliance as shares will be visible, and there will be 2 NSE, BSE Reliance. Then there will be Reliance. For example, December is already gone. So January future, February future, and March future. If you see futures, we will see 3 futures: Jan future, Feb future, and March future at present, which you can see in the stock market. Now, indices are having weekly expiry also and monthly expiry also. But stocks have only monthly expiry. So if you see, whenever you hear Bank Nifty, Nifty, Fin Nifty, they have expiries on a weekly basis. Nifty and Bank Nifty have expiry on every Thursday, every week. If Thursday is a holiday, then we shift 1 day before. So expiry is on Wednesday. But stocks, they have only one expiry, and that expiry is last Thursday of the month. If last Thursday of the month is a holiday, then we shift to 1 day before, which is Wednesday. Okay. Fin Nifty has a expiry, weekly expiry of Tuesday. Now, if I buy a share of Reliance, then that share of Reliance can stay with me for 1 day, 10 days, 10 months, 10 years, 100 years. Nobody can tell me that Reliance shares have expired. Until unless Reliance company is there, it is trading in the stock market, Reliance shares will have its value. But it is not the case with future and options. We just saw that futures and options, they have expiry. Now options have weekly expiry. Options of indices have weekly expiry. But futures, they have only monthly expiry. Future of stocks, indices, both, they have only monthly expiry. Future of indices and stocks, they both have only monthly. But options of indices, they have weekly expiry. Okay. So whenever we buy options, especially that too, when we buy options of indices like Nifty, Bank Nifty, we have to realize the fact that these are contracts which are valid only till the Thursday of the week. After Thursday, there is no value of the contract. The contract ends on Thursday. Okay. Yes. Moving ahead. Now, this is a simple example just to make and for me to understand whether you are getting this concept. Quickly answer this question. What is the underline in on the left side of the screen? What is the underline? Nifty. Very good. What is the lot size? Very good. 50. Very good. What is the strike price? So if you see this is something which you see, which is called as a strike price. So strike price is 17,200. What do you mean by CE? What do you mean by CE? Call European. Yes, exactly. It's a call option. Very good. I'm glad that you are getting this concept because I know this is very much basic, but I wanted to start from basic and move ahead. Okay. So the fourth concept, especially with regards to futures, is the spot price and the future price always same? It is rarely same. Future price are always a bit different, mostly bit different from the spot prices. So if you go and check now also, like in this example, if Reliance is trading at 2362.60, Reliance December future will be trading at 2372.3, approximately 10 rupee difference. 1 month more ahead, that is January future, will be trading at 2381.45, approximately 20 rupees more from the shares. 3 months more, it is 2391, approximately 30 rupees more. So 10 rupees here more, 20 here more, and 30 here more is the difference between spot and future. And this difference between spot and future will tell us whether the future is trading at a premium or at a discount. So if the future is trading at a higher price, then we say that it is trading at a premium price. Like if you see, whenever a new car is launched, there is always a waiting period. And if you want the car to be delivered earlier to you, or you want the car fast, then you pay some extra amount to the dealer so that he delivers the car to you first. The extra amount which you are paying to the dealer is the premium price, which is over and above the actual price of the car. Similarly, here also, whatever price we are paying in future is more than the actual price of Reliance. So Reliance is trading at premium. Sometimes we see that the Reliance is trading at 2362, but Reliance December future is trading at 2355, lesser than the current market price. In such a situation, we say that the future is trading at a discount. It means that we are getting future of Reliance at a lesser price as compared to the actual price of Reliance. Okay? Yes. Moving ahead, we at this point need to understand difference between cash, future, and options. So cash, with cash, whenever we buy stock, as we saw, we become part owners of the company, and time is our friend. Time is on our side. Nobody can tell us that your value of Reliance is decreasing because you're holding it for 3 months. We are not concerned about it when we are investing in Reliance. When we talk about future, future will give us profit only when we buy future and stock is increasing. It has advantage over cash. Cash, we will only make profit if the stock price increases. If the stock price decreases, we won't make any profits. But in future, we can use a thing which is called as selling a future, and we can even earn money when the stock is falling. So advantage of future over cash is we can trade both ways. Even when the market is rising, we can trade in futures. Even when the market is falling, we can trade and earn money. In cash, we can earn money only when the stock goes up. Advantage of cash, cash is king. If you have cash, if you have bought the stock with cash, you are not concerned about how much time to expiry is there, how much time I can hold the stock. You can hold the stock till you. Now, the problem with options is you need to be right not only about the direction. In futures, we are only concerned about the direction. If the stock rises, futures also rise. If it rises 10 points, future also rises 10 points. If it falls 10 points, future also falls 10 points. But in options, option pricing, the option price is affected by lot many more things than just the underlying. So in options, we are just not concerned about, no, cash doesn't mean options. Cash means putting in, for example, I buy 10 shares of Reliance, then 25,000 I'm investing and I'm buying 10 shares of Reliance. That is cash flow. I have put my money in cash like we normally trade. Normally, the normal way which we invest is cash. In options, the problem is we not only need to be right in terms of direction, but we also need to have the timing of the rise and timing of the fall correct. Okay, we will see more about it in subsequent slides. Okay, so options don't lose money. People do. When we trade without understanding what options are, how do they behave, and how is their price affected, that is when we get into losses. So options give us the right to buy or sell an underlying at a specific price till a specific period. And what is the specific period? That specific period is called as what is that specific period called? Expiry. Very good. So if you are buying an option, you have the right, but it is not compulsory. Okay. So suppose I buy 2400 CE of Reliance, and I see that Reliance has moved from 2400 to 2460. And there are still 10 more days left to expiry. Can I book my profit? Yes, I can book my profit midway. Before the expiry also, if I am in profit, I can book my profit. It is not compulsory for me to book my profit only at the time of expiry. I can book my profit anytime, till from the time I buy the call option till expiry. Expiry is the maximum period. In between also, if I feel that I am having profit, I can exit my call option because I am just giving off my right to buy. I entered it to earn money, to earn profit. I earned profit and I exited my contract. So these are all the things which we saw right now. Now, there are two types of options, call option and put option. Let us see what is call option first. So when we talk about call option is something which is similar to buying a house. When we want to buy a house, we give some token amount, and that token amount which we have given to the person who is selling a house is for booking that price for us. So either of the three situations can occur. One thing which can happen is the area where we bought the house, the area develops and a mall comes up and the price of the area goes up. In spite of this, if I have booked my price at 1 CR, I will be in profit because I can now buy a house which costs 1.2, 1.3 or 1.5 CR at 1 CR. Why? Because I paid a token. Is this clear? Is this concept clear? Yes, thank you. Now, if I have paid a token and a mall comes up and I don't want to buy the house, but I sell the house directly to some other person at 1.5 CR. So I am earning a profit of 50 lakhs. How much money have I invested? 10 lakhs. How much profit I am getting? 50 lakhs. So this is how option works. I am investing 10 lakhs to book my price. If the price of the area goes up, I sell it to some other person and I close my deal. I have invested 10 lakhs. I have earned 50 lakh profit. I didn't even purchase the flat or purchase the house in my name. This is how options work. Now, what is the second scenario which can happen? The price remains the same. So if the price remains the same, I have booked it at 1 crore. I have paid 10 lakh token. I'll pay the remaining amount and I'll get the house transferred on my name. So I am in a no profit, no loss situation. Now, what can happen? Something happens, some untoward incidents happens, and instead of area developing, the local municipal corporation decides that the area is suitable for a dump yard and a dump yard comes. Now the price of the house, which was initially 1 crore, now falls to 70 lakhs. So now, instead of having a loss of 30 lakhs by paying remaining 1 crore and getting the house in my name, and I know that even after buying the house at 1 crore, the value of the area has decreased and the house is not more than 70 lakhs now. I can let go of that 10 lakhs and I can save my 20 lakh loss, which would have been additionally been borne by me. This is how option protects us. So what are we losing? We are only losing our booking amount. And what is the booking amount when we talk in terms of options? What is the booking amount when we talk in terms of option buyers? Exactly. It's the premium which we pay. So at the most, what we can lose the premium. We won't lose more than the premium. So if I buy 2400 CE, and even if Reliance falls and goes to 1000 rupees, I won't be losing 1400 into 250. I will be losing only the premium which I have paid to the call option seller. Okay. This is one benefit of options. Now, how does a put option? Now, when you think of put options, always think of put options in terms of buying an insurance. So, for example, you buy an insurance of a vehicle. you have purchased a vehicle and you get an insurance for it. Now, when you are paying for an insurance, the amount which you are paying for the, sorry, not house, for the car, the insurance amount is 10,000. And the claim amount, the amount which you have booked for the insurance is 5 lakh of claims. So by paying 10,000 rupees, I am protecting myself from a loss up to 5 lakh rupees. So what will happen if the car gets into an accident? Then I can get money up to 5 lakh rupees. If the car doesn't has any accident throughout the year, then I am getting no money worth from my premium pool. But I will get a no claim benefit next insurance. But I am losing the insurance premium. So it is a way of protecting my risk. I want to protect my risk. I don't want to be in a very risky situation. And that is when I buy a put option. So put option is like an insurance. So to summarize, a call buyer has a right to buy, a put buyer has a right to sell. So when I am a call buyer, I am putting in my right to buy that particular asset. When I am a put buyer, I am putting in my right to sell that particular asset at a particular price within a specific time, that is within the expiry. Now, the call seller and put seller part I'll be covering just in a bit. So when the market is going up, I want to be a buyer of an option which is called as call. So I will buy a call if the market is going up. If the market is going down, then I will be buying a put. So buyer's options and buyer's intentions are clear that if the market is going up, then a call buyer will be in profit. If a market is going down, then the put buyer will be in profit. Now, here comes the interesting part. A call buyer will be buying it from someone who is selling a call. So, if the buyer wants the market to go up, that is, if he is bullish. When we say bullish, it means up. And when we say bearish, it means down. Why are these terms coined? They are coined in a term by the ways these animals attack. So bull uses his horns and pushes the opponent up. That is why a bull is pushing up. A bear, when he attacks, he strikes down over the opponent and he causes the opponent to fall. Therefore, bears are pushing the market down. So, a call buyer will be bullish. That is, he wants the market to go up. A put buyer will want the market to go down. Similarly, a call seller will want the market to go down. A put seller will want the market to go up. Is this clear? Is this clear? Is this concept clear? Yes, thank you. So is buying a call. Now, if you see, there are two types of options here. Call and put. And both these have two parties. One is a call buyer, call seller, put buyer, put seller. Now, this wants the market to go up. This wants the market to go down. This wants the market to go down. And put seller wants the market to go up. So, if you see the views of call buyer and put seller, are they same? Do you think they are same? The views of call buyer and put seller, are they same? Every option, there are two parties. Call option has two, buyer and seller, and put has two, buyer and seller. Call buyer wants the market to go up, put buyer wants the market to go down. So, yes, partly you are right, Tusharji, Rupeshji, but there is a slight difference. And let me tell you what the difference is. If a person is buying a call, then three things can happen. The market can go up, the market can go down, or the market can remain sideways. Now, a call buyer will only profit when the market goes up. Only this is what the call buyer will profit. But a call seller will profit even when the market is going down and even when the market is remaining sideways. Why this happens? I'll tell you. It technically looks the same, but this is a difference that a call seller will be even profitable when the market is running sideways. Why this happens? Because premium, as we saw, is wasting asset. The option is a wasting asset. So as the time to expiry comes nearer, the premium will go on decreasing. So even if the market remains in the same level at the same strike price and day to expiry is decreasing, then the call seller will become profitable. But a call buyer will be only profitable if the market goes up. Got this? Got this point? Clear? Yes. So this is a slight difference. Okay. And when we delve deeper, you will understand this thing. So let us go to the payoff chart. But before we go to the payoff chart, let me make you understand certain very important concepts where you will learn why option sellers are having an edge, what do smart money do, and how HNIs are playing the game of options. So there are four concepts which I want you to realize right now: premium, intrinsic value, extrinsic value, and then we'll touch upon Greeks. So these are very big terms, but don't get confused by the technical terms. Just understand the logic and everything will be very easy. So let me take you to this side. Okay. So what you are seeing right now is something which is called as an option chain. If you see here, this is an option chain. So option chain, what does it do? It arranges option in a chain fashion, one below the other. The lowest one is at the top, and as we go down, the strike price value goes on increase. So the option which is having the smallest strike price at the top and the option which is having the highest strike price is at the bottom. Now, understand certain very important concepts. Bank Nifty is presently trading at 42,821. If you see here, the strike prices are arranged at a difference of 100 from each other. 42,100, 42,200, 42,300, 42,400. So the difference between the strike prices is called as step. The difference between the strike price is called as the step. Step in Bank Nifty is 100 points. In Nifty, it is 50 points. In Reliance, it is 20 points. So if you see Reliance here, if we go ahead and if we search for Reliance, then you will see that the strike prices of Reliance are arranged one below the other in ascending fashion. That is, smallest strike price at the top, highest strike price at the bottom, and they are arranged with a difference of 20 points each. This is different for different stocks. Like the lot size, the strike difference or strike step is different for different stocks. Now coming back to our bank nifty. Bank Nifty is presently trading at 42,821. The strike price, this is the strike price which we say. This is the strike price, what we are calling a strike price. This is the strike price. The strike price which is closest to the current market price. Strike price which is closest to the current market price is 42,800 in this case. So 42,821. What are the next strike prices above and below? 42,700 and 42,900. So 42,800 and 21 is somewhere between 42,800 and 42,900. It is somewhere here, but it is closer to 42,800. That is why 42,800 is the strike price which is closest to the current market price, and it is called as at the money. At the money. So this is the concept of moneyness of an option. So the strike price which is closest to the current market price is called as at the money. Now, as far as the call options are concerned, these are the sides. On the left side, there are call options. On the right side, there are put options. In the center, there are strike prices. Now, this side, on the left side, the first column is LTP, that is the latest trading price of call option. Then there is something which is called as intrinsic value. Then there is OI, change in OI, and other things. Let's not go there right now. Concentrate here. The strike price, which is closest to the current market price, is called as at the money strike price. Now, as far as the call options are concerned, all the strike prices which are less than strike prices which are less than the current market price. That is, price has already crossed all this. These call options are called as in the money call options. This is at the money. All the strike prices above this are in the money, and all the strike prices below at the money are out of the money call options. So strike price less than the current market price in the money call option. Strike price greater than the current market price out of the money call options. This is call options. Okay. Exactly opposite will be put. Put at the money will be same. All the strike prices below are in the money put. In the money put. And all the strike prices above are out of the money put. So if you see, there's a zigzag here. Out of the money call options are below the current market price. Out of the money put options are above the current market price. Is this clear? Is this clear? Clear till here? Yes. Thank you. Thank you. Moving ahead. Intrinsic value, premium, and extrinsic value. So, let me take you this thing again. Yeah. So, if you see 42,800 strike price, if you see the price of the call option is 222. Let us write down the prices of these options. 42,800 to 22. So I'll write it down. 42,800 to 22. 42,500. 431 and 43,263. 43,263. Okay. So let me see if I can copy this, then it will be great. If I'm not able to copy, then I'll write it manually. It's, I guess I'm going to copy. Let's see if I can copy this. Okay, so I'm opening a sheet here and I'm pasting it. Let us see. Oh, just give me a second. Mm, NC, India, option J. Let me try to copy it from here. See whether we can paste it. Yes, this is good. So, uh, yeah. So now, um, these are the strike prices. We don't want this column. Ask, ask. Okay. Just give me a second. 42,800. This is, so, because we need these two things. Yes. Okay. Also, we don't do anything other than this. Okay. So these are the strike prices which are arranged one below the other. Now, if you see, Bank Nifty is presently trading at 428. What was the price we saw? It was trading at 42821. So 42821 is the price at which Bank Nifty is presently trading right now. And this is the at the money option which we are talking about. This is at the money. Now all the options which are above this in the call side are in the money. Now we want to understand what is the price of the options and how it is decided. So first thing is the price which you see here is the premium which call option buyer is paying to call option seller. So if I want to buy a call option of 42,800, then I will have to buy this amount multiplied by the lot size of Bank Nifty. That is, I will be spending about 5,500 rupees to buy this option of 42,800. So how much money I am putting? I am putting 5,500. How did I calculate it? The price of the option 42,800 price, it is premium multiplied by the lot size, that is 25 for Bank. Now we have to see why this premium is 222.55 and how is this calculated? What are the components? So when we say 22.55 is the entire premium, there are two components to it. One is intrinsic value and the second is extrinsic value. Now only the in the money call options have intrinsic value. Only in the money options have intrinsic value. Out of the money options will not have intrinsic value. Out of the money put options will not have intrinsic value. Out of the money call options will not have intrinsic value. What is intrinsic value? Intrinsic value means the value which an option is having because of its distance from the strike price. So 42,800, current market price 42821. The difference between 42821 and the strike price is the intrinsic value. So the intrinsic value of this call option is only 21. How is this calculated? 42800 is 21 points away from 42,821. Similarly, if we see 42,700 is 121 points away. So it is having 121 intrinsic value. Similarly, 42,600 is 221 points away and 42,500 is 321 points away. This is the intrinsic value. Intrinsic means it will, no matter what happens, even at the time of expiry, even if Bank Nifty expires at 42,800, even then this 285 will not become zero. It will still have 121 value. This 352 will not become zero. It will still have 221 value. This 429 will not become zero. It will still have 321 value. Similarly, put options will also be having intrinsic value. and that is calculated by strike price minus the current market price. So the intrinsic value is 79. And if we calculate for further, then you will see that this minus this is our intrinsic value. Strike price minus current market price is our intrinsic value. So this is how the intrinsic value is calculated. What does intrinsic value mean? That no matter what happens, the value this option is going to have, irrespective of where the expiry happens, even if it happens at 42,800, this value will be there in the option. Now, what is extrinsic value? Extrinsic value means it will go on changing because of other factors, which is not inborn quality of that strike price. And what is that? That is just the difference between the total premium minus the intrinsic value. So extrinsic value is, if you see, extrinsic value is 108 points here. And as you come closer, ATM, more extrinsic value is there. As you go deep in the money, less extrinsic value is there. If you see out of the money, there is only extrinsic value, no intrinsic value. So if this option, if we buy at 170 rupees today, and if it expires at 222, then if it expires at 42,800, then this 170 will become 0. 42,800, we bought 42,900 CE. And even if the market expires at 42,850, 42,890 also, then also this option will become 0 because it doesn't have any intrinsic value. All the value is extrinsic, and extrinsic value becomes 0 at the time of expiry. Okay? Clear about intrinsic value, extrinsic value in premium? Is everybody clear about extrinsic value, intrinsic value and premium? Give me a check in the chat if you are clear about intrinsic value, extrinsic value. Yes, thank you, thank you, thank you. So, so now we have covered most of the basics, not all, but most of the basics. Now there is something which is called as Greeks. This is where we move to option Greeks. And before we move to option Greeks, let me give you a small introduction about option Greeks and option payoff. So option payoff, why do we need to know this? So for example, the thing which we saw just now, if we see the thing which we saw just now, we have got 42,800 at 222. Okay, 42,800 call at 222. So if I have bought 42,800 call at 222 rupees, listen to this very carefully, because this is why option buying is very crucial. You need to understand this very carefully. I have bought 42,800 at 222 rupees. Now, what do I expect? I expect Bank Nifty to go up. When will I start making profit in this call option? When will I start making profit in this call option? To know when will I start making profit in this call option, I need to understand the concept of break even. Now I have bought 42,800 CE at 222 rupees premium. It means I have already paid 222 rupees extra for 42,800 call. I will be profitable only when 40, no, not at all. It will not be, I will not be profitable when 42,800 is crossed. That is the exact thing which I wanted to realize. 42,800 call bought at a premium of 222. Yes, now you're getting it. So I will be profitable only when Bank Nifty crosses 43.22. How did I get this figure? 43.22. I added the strike price with the premium I paid. Strike price plus premium is my break-even point. So I will be no profit, no loss if Bank Nifty expires at 43,022, 43,022. I will be profitable only if Bank Nifty closes above 43,022. I will not be profitable if Bank Nifty closes above 42,800. Clear? Is this concept clear? Yes, thank you. Similarly, if I buy 42,800 put at 177, what will be my break-even point? $42,800, but put I am buying. So what will be my break-even point? Anybody? Bank Nifty price. 43,222 is Bank Nifty. If Bank Nifty closes above 43,022, then I will be profitable. Very good, Vipulji. Very good. 42,800 minus 177, that is 42,673. So my break-even point is 42,673. Oh, sorry, 623. 623. 42,623 is my break-even point. It means that if Bank Nifty closes at 42,623, I will be in no profit, no loss. I will only make profit if Bank Nifty closes below 42,623. Is this clear? Is this concept clear? Yes, thank you. These are very important concepts. Lacking of these basic concepts will lead us to get losses in our option trading. Now we come to another important feature of option Greeks. Now we just saw that when we pay a premium, there are two components of a premium. One is intrinsic, which is decided by the distance from the current market price, and the second is extrinsic. Extrinsic means external factors. So what are these external factors? These external factors are Greeks. These external factors are called as Greeks. And what are Greeks? Now don't go into all these. Why are they called Greeks? Because they are using Greek language for denoting them. And there are different types of Greeks. Delta, theta, gamma, and vega. These are the four main Greeks. Last one is rho. I will tell you about that too. Now, instead of going into theoretical part of this, I want you to get the basic concept and practical concept. Okay. Yeah, I take the question, Rajuji. I take the question. Just pay attention to this. This is very important because I am not going to teach you theoretical aspects. I am going to teach you practical aspects. So please pay attention. So let me again take you to this website. Now, I want you to answer one question. I have bought 42,800 call with the hope that Bank Nifty will go to 43,000. That is, I want a 200-point move in. I am expecting a 200-point move in Bank Nifty. So if the Bank Nifty goes from 42,800 to 43,000, that is 200-point move. How much will this premium be? If Bank Nifty goes from 42,800 to 43,000, will it increase by 200 points? No, it will not. It will increase by a smaller amount, and why and how? So whenever we say we want to know how much will the premium change, that calculation is done with respect to delta. So what is delta? Delta tells us how much movement will a premium make if underlying is moving 100 points or 200 points or say 500 points or say 50 points. If there is a movement in Bank Nifty, how much will this premium change? If a movement is there in Reliance, how much will the at the money premium change? So delta tells us the movement of the premium with respect to the movement of the underlying. Clear? Is this clear? Movement of the premium with respect to the underlying. So if Bank Nifty moves 200 points, how do we calculate? We multiply the movement which has happened. For example, a 200-point move in Bank Nifty multiplied by the delta of that option. In this case, it is ATM. So ATM is mostly near 0.55. So it is 0.54 as you can see here. So 200 into 0.5, approximately a 100-point move. So this 222 will not become 422. It will be close to 322. Okay. Now suppose instead of 42,800, I have bought 42,000 call option. And again, Bank Nifty moves from 42,821 to 4,321. Again a 200-point move. What will be the price change in this option? 42,000. Can somebody tell? How much will be the price change of 42,000 for a Bank Nifty movement of 200 points? Yes, very good, very good. Right? Yes, 0.92 multiplied by 200-point move. So close to 184-point move. So now you see at the money call option for a 200-point move, it moved approximately 100 points. But in the money call option, moved 184 points. Now, if we see that if I had bought 43,300 call option for a similar 200 point move. The delta of this is 0.17, even if you consider 0.2 and multiplied by 200, then it would just give a 40 point move. So options are very typical in the way how they behave according to where they are, whether they are at the money, in the money, or out of the money. For a similar price movement of Bank Nifty, at the money call option will move only 100 points, in the money will move 184 points, and out of the money call option will move only 40 points. This is the reason out of the money calls are cheaper. Getting this? Getting this? Yes. Yes. Now, what are the other call options and how do they affect our trading? So, when I talk about theta, theta means how much time to expiry is remaining. Now, there's a very important concept in Bank Nifty, very important concept in option trading, which is called as time to expiry, that is theta. And many of you might have heard or experienced this, that suppose you bought a call option of 42,800 today at 222. Tomorrow at 12 p.m. you again check Bank Nifty is presently reading at 42,821. Tomorrow at 8:22, again Bank Nifty is trading at 42,821. Even if this is happening, the premium will decrease from 222 to 200. There will be decrease in the premium. Why is this decrease happening? Because today, that is Monday. Today is Monday. So days left to expiry is 1, 2, 3. 3 days are left to expiry. Tomorrow, only 2 days are left to expiry. If we go further, if on Wednesday, again, if Bank Nifty is trading again at 42,821, then the value of this premium will again decrease to 150. It will go on decreasing as the time to expiry will come nearer. And this is something which is not happening in a straight line. This is not happening equal proportion every day. So for first 70% of the period of expiry, the theta decay or loss of premium due to expiry coming nearer is almost a plateau. But in the last 30% of the time left for expiry, the decay is exponential. Now, what does this mean? This simply means 70% of time left for expiry. So if we consider 1 week, how many days in a week? 7. 70% of 7 is 4.9 days. First day of expiry is Friday. Last day of expiry is Thursday. So Friday, Saturday, Sunday, Monday, Tuesday, Wednesday. 4.9 is approximately 5. So 1, 2, 3, 4, and 5. Till Tuesday, the expiry will not affect much. There will be slight decrease. So maybe till Tuesday, if this is 222, it will go to only 200. But on Wednesday, as soon as Wednesday starts, And if this price is not crossing our break-even point or going towards our break-even point, then the decrease in the premium will happen very fast. It will move from 222 to 150 to 100 by Wednesday evening to Thursday morning. It will come down to 50 rupees. And this is very fast. In the last 30% of the period, it happens very fast. If we consider monthly expiry, there are 30 days in a month. 70% of the monthly expiry means first 21 days, that is 3 weeks. So in the first 3 weeks, the effect of theta decay is not much, but in the last week, theta decay occurs very fast. Therefore, if we are trading in options, in stocks, we should be very careful. In the first 3 weeks, we are safe. But as we come to the last week of expiry, we should be very careful and we should start booking our profits or start closing our positions. Is this clear? Is this clear? Yes. Now, other things which affect are gamma and vega. So, gamma and vega, gamma is change of delta itself. For example, now we have got 42,800 CE. It was at the money. So it was having a delta of 0.5. If this starts moving up and it goes to 42,900, then this delta will also change. It will become 0.6. And the faster this goes to 42,900, the more there will be change in delta. So this rate of change of delta is called as gamma. Understood? Understood this gamma concept? Yes. Now, there are two more Greeks. And out of it, one which is called as vega is very important. Why? Because the entire option cost is directly proportional to the volatility. The more the volatility, the greater the cost of the options. Less the volatility, lesser the cost of the premium. So if what do you mean by volatility? Volatility means movement from high to low. So if you see Nifty, if it moves like this, Bank Nifty moves like this. The distance between high and low is the volatility of Nifty. The difference between high and low of Bank Nifty is volatility of Bank Nifty. Each stock, each index has its own volatility. This is one thing. Internal volatility of the underlying. Bank Nifty by itself is very volatile. A 200, 300 point move, 400 point move in Bank Nifty is not abnormal. It is normal. It happens day in and day out. We see 200 point, 300 point move in Bank Nifty. But do we see such kind of movement in Nifty? No. Nifty by itself is less volatile. There is less movements in Nifty as compared to Bank Nifty. This is one idea of volatility. Second idea of volatility. Days when there are important events happening. For example, there is a budget coming up. Then the volatility in the market increases. I am talking, this is volatility of the Bank Nifty. Now, if I am talking about stock, suppose consider Reliance. Reliance, it is going to announce its quarterly results. Reliance is going to announce a merger. Reliance is going to announce a partnership deal or a government contract is acquired. These are the days when there is increased volatility in that particular stock. So increased volatility in that stock will lead to increase of premium and increase in price of the option. Is this clear? Is this clear? Okay. Now, only one thing is left, which is called as rho. Now, what is rho? Rho is dependent upon the interest rates. Interest rate is decided by the RBI in India. So, whenever the interest rates are changed, rho is affected. Only this much is required. We only want to learn practical things. We don't want to go into theory. Okay. So, I was planning to cover only this much till today because I want to go slow. And tomorrow we'll be learning about option chain, PCR, max pain. These are important concepts that option traders should know. Okay. Then we will also learn how do we decide trends looking only at the option chain. How do we decide support resistance looking only at the option chain. Okay. And this is something which we just saw, that at the money will have approximately 0.45 to 0.5 delta. And as we go in the money, the delta will go on rising. As we go out of the money, the delta will go on decrease. Okay. Now I am open to questions which you might be having, because this class was only intention of taking this class was to clear some concepts which many of you might be having, especially if you are trading in options and blindly trading in options. Okay.
I learned something about options.
Yes, good.
सर और एक क्वेश्चन था